Dell Technologies didn't just beat expectations, they fundamentally rewrote the hardware landscape. Total revenue reached a staggering $43.8 billion, an 88% year-over-year surge. Driving this surge, the Infrastructure Solutions Group delivered $29.0 billion, up 181%. Within this, AI-optimized servers were the absolute standout, exploding 757% to capture $16.1 billion. This hypergrowth was supported by traditional servers surging 92% to $8.5 billion and storage adding a highly profitable $4.3 billion. Beyond infrastructure, Client Solutions maintained a solid $14.6 billion baseline, driven heavily by $13.0 billion in commercial sales. This massive scale translated directly into record profit. Gross profit hit $7.8 billion, and operating income reached $3.7 billion. Most impressively, net income jumped 256% to $3.4 billion, securing a resilient 8% net margin. The final verdict? Non-GAAP EPS of $4.86 crushed the $2.96 estimate, a 65% earnings beat of historic proportions. To truly appreciate the velocity of this breakout, we must examine the historical tape. From Q1 FY23 through Q4 FY24, total quarterly revenue was trapped in a consolidation range between $20 billion and $26 billion. Then, the AI supercycle ignited. Infrastructure broke decisively higher, scaling rapidly from $12.5 billion up to a record $29.0 billion in Q1 FY27, while Client Solutions held a steady $14.6 billion. When we smooth out this multi-year curve, the structural divergence becomes clear. Infrastructure carried a dominant compound annual growth rate of 32.9%. Conversely, Client Solutions actually contracted by 1.6% annually, reflecting the broader post-pandemic PC market cooling before the current AI upgrade cycle took hold. Dell is not merely participating in the AI revolution. It is architecting it across four core pillars. First, infrastructure, generating $29.0 billion, up 181%. This engine is fueled by a $51.3 billion backlog and $16.1 billion in direct AI server sales. Crucially, traditional x86 servers surged 92% to $8.5 billion, acting as essential orchestrators for agentic AI. The momentum is undeniable, with $24.4 billion in fresh AI orders secured in just one quarter. Second, Client Solutions provides a highly lucrative cash flow buffer, delivering $14.6 billion with a staggering 79% jump in operating profit. Integrated NPUs like the Snapdragon X Elite are triggering a Copilot Plus PC super upgrade cycle, catalyzed by an aging 4-year install base and the Windows 10 end-of-life deadline. Third, an uncopyable ecosystem. Dell's AI customer base expanded 50% in 6 months to over 5,000. Their attach rate strategy flawlessly pulls high-margin storage alongside every AI server. Paired with their NVIDIA alliance to engineer direct liquid cooling for the Vera Rubin NVL72 platform. This is a technological fortress. Finally, a definitive power shift in market share. Dell commands 46.7% of the AI server market, nearly doubling SMCI's 25%. Cemented by a $9.7 billion federal defense contract, FY27 projections have been aggressively raised above $165 billion, with AI servers targeted to hit $60 billion alone. What justifies this $60 billion target? The raw data. Across orders, revenue, and backlog, every single trend line has gone parabolic. Orders surged to $34.1 billion in Q4 FY26, and Q1 FY27 just booked another $24.4 billion in fresh commitments. Revenue followed the exact same explosive arc, launching to $16.1 billion. But backlog is your most decisive forward indicator. From under $4 billion in early FY25, it has compounded to an astonishing $51.3 billion today. That is secured, committed revenue fully validating their raised $60 billion FY27 target. This momentum is deeply integrated into a broader, dominant ecosystem. Dell's infrastructure is now the undisputed bedrock for strategic partners, including NVIDIA, OpenAI, Palantir, AMD, and Meta, while seamlessly powering rising AI innovators like Cohere, Mistral AI, Google Cloud, Reflection, Hugging Face, and Glean. This AI monopoly isn't happening in a vacuum. It is built on a decade of relentless execution. In the mainstream server market, Dell's share climbed steadily from 23% in 2015 to a dominant 29% today, leaving competitors stranded in the low teens. The generational server upgrade cycle is accelerating this shift. Upgrading to 17th generation machines delivers up to 5x more processing cores and 235% better power efficiency, allowing enterprises to replace 5 to 7 legacy servers with a single rack. In the high-margin storage sector, Dell commands absolute leadership across the board. They capture 33% of the high-end market, 23% of mid-range, 25% of unstructured data, and a massive 41% in data protection hardware. The Dell AI data platform is purpose-built to feed these AI workloads, ensuring expensive GPUs are never starved for data. While the data center grabs the headlines, a silent, highly profitable revolution is happening on the enterprise desk. The global PC market is migrating decisively upmarket. Looking at the IDC data, the consumer premium segment expanded from just 18% in the 2018 to 2019 baseline to 27% today. Simultaneously, lower margin segments are being squeezed. Consumer mainstream contracted from 33% to 23%, and commercial mainstream shrank from 28% to 20%. Dell is positioned exactly where the capital is flowing. They have achieved a 7% unit compound annual growth rate in the premium segment, capturing 28% market share. Conversely, they have intentionally retreated from the volume-heavy, low-margin rest of market, choosing to prioritize sustainable profitability over empty market share. Zooming out on the macro landscape, the global PC market is emerging from its longest correction in history. After the massive work-from-home spike in 2021 pushed shipments to 349 million, the subsequent hangover brought volumes down toward 278 million. However, industry analysts project a sustained recovery runway from here, crossing 300 million units by 2027 and reaching 315 million by 2029. Looking across the competitive landscape, while Lenovo and HP battle fiercely for sheer volume and Apple defends its walled premium garden, Dell is playing a strategically different game. Tracking at 42 to 45 million units, Dell is weaponizing the AI PC supercycle to extract maximum margin per device, rather than chasing absolute unit supremacy. Combining this data center monopoly with the PC supercycle brings us to Dell's forward roadmap. This is a financial supercycle with no historical precedent. Financially, management has aggressively raised their target revenue to between $165 billion and $169 billion, a 50% growth trajectory. AI servers alone are targeted to hit $60 billion, up 145%. They are rewarding shareholders with a $10 billion buyback and a 20% dividend yield increase. Technologically, the expansion is flawless. Starting at the core of the data center, the future IR7000 integrated rack fits 256 GPUs per rack with direct liquid cooling, delivering a 75% total cost of ownership savings using the AMD MI300X. To feed that massive compute, the PowerScale F910 eliminates GPU starvation with 300 PB of capacity and a guaranteed 2:1 data reduction. Finally, extending this power out to the edge, the Copilot Plus PC delivers 45 TOPS via the Snapdragon X Elite, featuring a 27-hour battery. Operationally, Dell is untouchable, a 4.2-hour mean time to repair compared to the 18-hour industry average, a hardware failure rate below 0.5%, and a resilient China Plus One supply chain strategy bridging Vietnam, India, and Mexico. Massive revenue growth is impressive, but true Wall Street value is created through operational leverage. Despite top-line revenue surging 88% in Q1 FY27, selling, general, and administrative expenses rose just 6% year-over-year to $3.1 billion. And over the long term, these expenses are actually decreasing. Meanwhile, research and development continues a steady 9.6% multi-year growth trend. Dell is aggressively funding future innovation while successfully starving corporate overhead. As a result, operating expenses as a share of total revenue have compressed to their lowest level in over 2 decades. Pure operating leverage, compounding at scale. And here is the ultimate payoff of that strict cost discipline. Before the AI inflection, back in fiscal year 23 and 24, the hardware market was punishing. Enterprise budget freezes, post-pandemic gluts, and supply chain constraints compressed net income margins to a painful 1% to 3%. But the generative AI revolution completely inverted the script. Look at how this super cycle compounds margins upward. 6% in Q2 FY26, 7% in Q4, and finally, an 8% net income margin in Q1 FY27, generating $3.4 billion in absolute cash. That is more than 3x the quarterly earnings of just 2 years ago. When an AI inflection point hits, Wall Street's forecasting models inevitably break. Historically, Dell's revenue track record against consensus was highly inconsistent. But Q1 FY27 completely shattered that baseline, reporting $43.8 billion against a $35.7 billion estimate, delivered a massive 22.7% top-line blowout. Wall Street was completely blind to the magnitude of this enterprise AI demand surge. Now, factoring in Dell's sovereign government contracts and a massive capital rotation away from scandal-plagued competitors like Supermicro, analysts are scrambling to catch up, projecting continuous $40 billion-plus quarters through FY28. The earnings per share sequence tells an even stronger story of market underestimation. Since a rare miss in early FY26, Dell's earnings momentum has accelerated sequentially. This culminated in a historic Q1 FY27, reporting $4.86 against a $2.96 estimate for a staggering 64.1% beat. While revenue grew 88%, Non-GAAP EPS expanded 214% year-over-year. Fueled by this momentum, management just raised their full-year EPS guidance to $17.90, crushing Wall Street's $13.15 consensus. Institutional models aren't just being adjusted, they're being ripped up and rewritten. When this earnings report dropped, the market response was violently bullish. The stock detonated, surging nearly 33% in a single trading session. What poured gasoline on this euphoria was management's aggressive capital return program. They didn't just post good numbers. They executed a $2.1 billion buyback to retire 11 million shares during the quarter, bumped the dividend by 20% to 63 cents per share, and authorized a massive $10 billion for future repurchases. This level of insider conviction triggered a mass re-rating of Dell from a legacy hardware vendor to an AI infrastructure monopoly. However, a critical word of caution: when momentum runs this hot, the risk of sudden, aggressive profit-taking is ever present. Valuations are stretched, and any macroeconomic tremor or delayed GPU shipment could trigger a sharp pullback. Still, the analyst community remains overwhelmingly constructive. The consensus one-year target sits at $449, with the bull case reaching $700. Out of 29 analysts, 19 rate it buy or strong buy. With a $51.3 billion backlog acting as a concrete revenue floor, Dell undeniably owns the enterprise AI era. As always, please remember this analysis is for informational purposes only and is not financial advice. Always conduct your own due diligence before deploying any capital. If this deep dive gave you an edge today, hit the like button and subscribe for more institutional-grade financial analysis. Thanks for watching, and we'll see you in the next breakdown.